Aloha, and thank you for joining us for another episode of Financial Planning with Hawaii Central Federal Credit Union. I'm Amber Millsap, Community Relations Officer with Hawaii Central. Today I have with me Herb Hussey. Hi Herb, how are you doing today?
We're fine. Thank you very much.
Herb, again, is with Windward Financial. He is a partner there. And today he's going to be sharing a little bit about life insurance with ABR. Now, before we begin, though, Herb, I'd like to ask you, for our viewers that are joining us for the first time, to tell us a little bit about yourself. I know this is your favorite part.
And thank you. Move on.
No. Really?
I've been a retirement planner since 1990. And one of the important parts of retirement planning is to make sure that people's foundational part of their lives are stable. And one of the key elements in that is to make sure if they have a family, kids, or debt, that they have a way to help their family in case they pass away. So that's where life insurance comes in. It's a normal and accepted, a very reasonable part of people's financial planning, retirement planning, estate planning.
So 1990.
Yes. Yes,
That's how
I
many
can do the
years?
math on that.
Yeah, no, that's a lot. That's great. You have a lot of experience, and we're looking forward to your presentation today
Let's
on
move on.
life insurance with ABR.
First slide. Life insurance with ABRs. It's called Life Insurance with Accelerated Benefit Riders. Accelerated Benefit Riders. What does that mean? Next slide. Traditional life insurance, the benefit there is that someone is going to get a check when you pass away. The general rules is that you purchase a life insurance policy. It is an adhesion policy, which means that you don't get to choose the parts of the policy that you like or don't like. The company says, this is our offer, and your choice is to accept or not. You can choose a cash value policy, which may have a level premium that goes for as long as you live, or a term policy, which is one that has a level premium and a level coverage for a certain number of years. Generally, the term insurance policy is cheaper because it's for a specific period of time. A cash value policy can be more expensive. So those are the differences. The similarity is this. Life insurance proceeds are generally tax-free. What that means is if you pass away and you leave your family a life insurance policy of $100,000, that $100,000 is equivalent to that family inheriting an IRA for $150,000 because the life insurance proceeds are tax-free, right? The family gets the check and that's theirs. I had a client a few years ago who died suddenly. They were on a trip. Like most families here, they had a mortgage of almost $1 million, a first mortgage and a HELOC. And when the gentleman passed away suddenly, the wife knew that there was life insurance there, but she couldn't find the policy initially. So we spent time looking for it. We finally found it, contacted the insurance company. They were able to verify over the phone the policy was still in force. It was a term policy. They immediately
Thank God.
told the lady how much the insurance was. She submitted a claim within a week or two. After submitting the claim form and the death certificate, she got a check for $1 million.
That is wonderful. I know it's such a difficult time. That's why, and
yes,
especially if you have a mortgage.
Correct. And in this lady's case, what she did was she called me up and she said, I got the check. What do I do? They said, go to the bank, pay off the loan. So within half an hour, the loan was gone.
So what was the loan?
$850,000.
That is such a blessing.
Yeah,
at that
first
time.
mortgage of $500 and a HELOC of $350.
When you're
So-
grieving.
Oh,
and,
yeah. Because when you have a debt like that, where it's on a property and is owned by a husband and wife, okay, the thing is that the property isn't usually owned by the man and by the woman. It's owned by Mr. and Mrs., joint tenancy. So what happens there is that the policy then, the policy, the money goes to the wife. She turns around and pays it off. That home is now hers.
But if she wasn't able to pay it off, then
If she wasn't able to pay it off entirely, what would happen is the lender would say, okay, well, we paid off this amount, but you still owe this. All right. So if the person is married, they have kids, or they have a debt, one of the things that's very important for them is to have enough insurance to take care of their families. If not, we can leave our families in a really tough situation.
Now, tell me a little bit more, though, about this ABR thing.
ABR, accelerated benefit rider.
Okay.
What happens there is, whether it's a term policy or cash value policy, the newer policies oftentimes have a provision that says, you have $1 million policy, term insurance, all right? But if you become terminally ill, where you have a year or two left before you pass, chronically ill, where you have an illness that is there permanently, or critically ill, where you've had something very serious that has occurred, like a heart attack or a stroke. Okay, the newer policies take that $1 million of life insurance, and you have access to portions of that death benefit now, while the person is sick, rather than waiting until the person passes away. I have been in meetings with families years ago where the father had a stroke. They were behind on the mortgage, and the son comes in with a life insurance policy and says, we'll give you this, just don't foreclose on my mom. And the lender says, I'm sorry, we can't do anything with this policy until your dad passes away. But the newer policies, where they accelerate the death benefit, all right, the family now has the ability to get cash to take care of themselves when the person is very ill, particularly because things like long-term care are extraordinarily expensive. People say, well, how can a company afford to do that? If you have $1 million term policy, why would they do that? If you think about it from the insurance company's point of view, they're on the hook for $1 million no matter what. Okay, if you pass away, they're going to write your family $1 million check. Okay, but if they give you a portion of the life insurance now, and then when you pass away, they give the rest of it to the family, it's still the same $1 million. They're not on the hook for more. The only difference is that they are able to give you a chunk of that while you are alive. So one of the things that I do as a practitioner, I'll ask, do you have life insurance? Yeah. How long have you had it? 20 years. You don't have this. How come? Because accelerated benefits have only been around for a few years. Does it cost more? No.
Couple things there. So what about things, because I know about long-term care insurance a little bit.
Yeah.
Is this similar to a lot of long-term care insurances or insurance policies don't cover things like cancer, or short-term income protection? These kind of supplementary insurances don't cover cancer. Like you have to get a separate cancer insurance.
Yeah.
Does the accelerated benefit rider cover something like cancer?
My suggestion is have a conversation with your insurance guy, your financial broker, whoever that person is. If you're interested in this, have them research it, because there are some plans that are very broad, and you look at the definition of what critical illness is. How do they calculate how much money they'll let you have? Terminal illness. Because the concept has been around now for a few years, you can look at it and get a pretty good sense of how this thing works. And you find something that you like, my suggestion is go get it.
Main thing, read the fine print.
Read the fine print. See what it does. See what it does.
I guess that would be the same
For
answer
anything.
if I were to ask you about illness due to an injury.
Correct.
Yeah.
I'm candidly, I'm not a fan of telling people to purchase a long-term care policy. Now, this is my own personal opinion. Other people have other opinions, but my personal opinion is that a long-term care policy, a standalone long-term care policy, is not something I would recommend my clients buy first, because in my view, my view only, it's one of these things where you either use it or lose it. Mm-hmm. If you never needed long-term care, but you lived a long life and you died and you passed away, oftentimes the premium you paid for a standard long-term care policy is gone. Mm. It's gone because you didn't need the benefit. Same thing if you purchased let's say a cancer insurance policy and you died of a heart attack, or if you have accident insurance policy and you died of cancer, right? They're going to pay based upon what happened. As a practitioner, I'm more concerned about making sure my client has enough of a wide width when they make decisions so that if something does happen, that it's going to be something that they can recover from. Mm-hmm. That's why I tend to suggest accelerated benefit policies, because even if they don't die after a long-term care need, or they don't die from a heart attack or a long illness, if they just pass away, there's a life insurance for the family.
Yeah, it kind of covers all bases.
Yeah, and that's, as a practitioner, I'm very aware that people only have so much money to spend on stuff, mm-hmm. right? So we have to be judicious and thoughtful in what we're doing. So what I try to do is ask my client, what do you need? And they say, well, I need this. And they said, well, I want to buy this, this, or the other thing. I said, well, okay, well, what happens if that thing doesn't happen to you? Mm-hmm. Are you okay with that? Yeah, I'm okay, because that's something that happens in my family. Maybe cancer insurance is necessary because it's something that happens in my family. Okay, right? Other people say, well, long-term care is important, and I can afford it, even though it's maybe more expensive than I would like it to be. I'm okay with it because it's very important. All right. Other people say, well, I really don't know. And then, okay, in that case, let's make sure that if you did pass away, you have enough to take care of the mortgage and the kids, right? But if you got sick, that there's a opportunity there for your family to have access to the death portion of the death benefit now, mm-hmm. so that you're going to be okay. Mm-hmm. What I've seen in my practice is this: when people get sick, it's not only hard on them emotionally, physically, it's extremely hard on the family financially. Mm-hmm. Even though they may have health insurance that'll only pay for the medical stuff. They may have sick leave. It just replaces the time that they're not at the office. But if you need someone to come in and take care of you when you're recovering so your family can continue to work, your medical insurance and your sick leave won't cover that.
Yeah.
It won't. And
a lot of times you lose your medical insurance because you're unable to work, right?
Correct. And oftentimes we see people that are injured, right, and they're home recovering, but because they need more money, they said, you know what, I got to go back to work. I got to go back to work. So they're pushing themselves to go back, which makes it harder for them physically. So as a practitioner, my concern is, look, if we're home and we're recovering, we want to have some money that we can take care of ourselves with so that we can get better without pushing ourselves to do that. Mm-hmm. Mm-hmm. Just as when we talk about people's retirement, oftentimes there's a tendency to focus on the money. As they get older, they focus on the medical. Mm-hmm. And the medical becomes really important.
You mentioned that you can access portions of the benefit. So it's not the entire benefit, or is it possible that you could...
If you look at some of the policies that are out there, what they'll do is they'll say, if you have like a critical illness, okay, they will segregate out and say, okay, if you have a moderate event, a serious event, or a life-threatening event, they'll have three different categories of the kind of event that you've had, and they'll tell you, okay, if you have this one event over here, mm-hmm. of this insurance policy, we're going to give you this. Right? If you have this one, we're going to give you higher. If you have this one, it's going to be more. But they should be able to actually tell you that in the literature when you're thinking of purchasing. Okay. So that you have an idea.
Again, read the fine print.
Read the fine print. Because it's an adhesive contract, which means they're going to come up with an offer. Your choices are either to accept or reject. Mm-hmm. It's not a contract where you get to negotiate with them about their offer. It's not how it works.
Okay.
So,
thank you.
Which is the right type of insurance people should buy? They should buy what they can afford, right? So if they can afford this, don't buy this, because what will happen is if we are pressured to buy more than what we can afford, when times are hard and they're cutting back on our hours at work, we're going to cut back on stuff and we're going to end up cutting this.
Yeah.
Better stay here. People say, well, it's term insurance. It doesn't matter. It's still going to pay a claim. It's going to pay a claim if you get sick or you die. So what you pay for it is really a matter of what you can afford as you live your life. So do that. Traditional life policies, they'll pay with the premium stays the same, and then what will happen is you're actually overpaying the policy. You're putting more money into it so that it has this cash value component. I'm not a big fan of doing that because you're paying more for something, and I would rather make sure that they have enough food all the time. They can save some money.
You're talking about the cash value?
Yeah, right. I'm not a
Okay.
fan. I'm not a fan of having cash value policies because people want to have a lot of cash value in their policies. To me, that's something that's an interesting concept, but no, I'd rather they have enough insurance, because here's the thing. If you have $1 to spend, the amount you can buy with a cash value policy, if you have $1, is way smaller than what you could buy for the same dollar if you're buying term insurance.
I have a couple questions about cash value. Is this what is referred to as universal or whole life insurance?
Right.
Or are those two different things?
They are two different things.
Oh,
Okay, a universal, but it's the same thing. It's a cash value. So when you have a cash value policy, the company says, okay, you have $100,000 coverage if you drop dead. The actual cost for your policy is maybe $25 a month, but you're going to pay $100. Why? Because we're going to take your $100. We're going to keep $25 to keep the policy going. The other $75 we're going to put over here in this cash value account.
okay.
And you can choose different things you want to invest it in, and it's going to go tax deferred. It's going to become a bigger number later on. That's conceptually how this thing works. All right. But on the other hand, okay, a term policy will cost you $25. Period. You do anything else you want to do with the $75 that you didn't put into the cash value policy.
Exactly, right? You could invest it yourself, right?
Buy food.
Yeah.
take the kids, save enough money, take the kids on vacation. So I'm not an advocate of buying stuff. To me, that's just kind of low.
So, though I've heard of these cash value policies and borrowing from them.
Yeah, that is a nuance.
Okay.
It is a sophisticated idea, and what they're doing there is they're using the structure of a cash value policy to create a retirement income. So back to our example of $100,000 policy, and they actually need $25, but you're going to give them $100. Well, let's say you didn't give them $100. Let's say you gave them $500. Why would you do that? Well, they only need $25, so they can put the $25 over here. But the other much bigger amount, they're going to put in this cash value policy, the cash value side. And this thing, you keep funding it like that, it gets bigger and bigger and bigger and bigger. And it's growing tax deferred. You haven't taken the taxes out. This thing is getting bigger and bigger and bigger. So over time, usually decades or two, this policy now, okay, the death benefit is $100,000, but maybe the cash value portion is also $100,000. Why would they have done this? Because let's say they put away, they say, I don't really need the death benefit, but look at my $100,000 in cash value. Okay, I want to take that out and I want to spend it and I don't want to pay taxes. So what they do with that is they take loans, they keep the money. There's a loan against the policy, and they keep taking loans out, and then they die. What happens is they haven't paid the policy back, but maybe they took out 90 grand. The family is not going to get 100 grand. They're only going to get 10. Because what he did was he overfunded his life insurance and used that as a vehicle to receive money. I've seen this out there. It's an interesting idea. I wouldn't recommend anybody doing that until, number one, they've put all the money they can into their 401k account. Okay? They have a Roth account because a 401k is taxable usually, but Roths are tax-free. Okay? Paid off all their bills and done all the stuff they want to do before they go do that. So that's one of those interesting concepts that in practice, I've never seen it used.
I know my son purchased, you talked about this earlier, he purchased a policy and then wasn't working for a period of time. And he's like, I don't need that anymore, but lost, all the premium he put in, right?
That's the problem. See, the upside is this beautiful picture about how you're going to get all this money out and walk away, and and you kind of like fool people because it grows tax deferred. You don't pay the taxes, and then you take it all tax free. You don't have to pay it back. It's like, wow, the ultimate scheme. The problem is this: if you cannot continue to pay the premium, what happens then? See, let's say the person in that scenario loses their job. Well, that policy that they need $25, they still need the $25. Where are they going to get it from? Not you, because you cannot work. They're going to take it from the cash value.
Oh, okay.
Yeah, because their obligation is to keep the policy going.
Well, they are obligated
Sure.
if you have that cash value portion.
The cash value component is connected to this policy. So if you stop putting the money over here, they're going to take the money from this. So they keep going that. So if the person doesn't pay for it after a while, this pot of money gets smaller and smaller and smaller because it's feeding this. And if they don't have enough, they haven't put in enough money into this plan. If let's say it happens within the first few years that they lose their job or something like that, there isn't enough money here to fund this thing. And after the money goes there, it stops and the policy lapses. Ran out of money. Life
insurance.
And all the money they put in is gone. Last week I had a conversation with a client who was approached by a friend to do this very thing. And my first comment was, your friend, what does he do? He says, oh, he works this other place. Is this a full-time job, this insurance thing? No. He just heard this concept. He thought it was good. I said, you trusting something real serious to somebody who does this part-time? He goes, well, you full-time. I said, yeah, I'm full-time. I still don't do that. Why? Because I cannot guarantee when I look at that young man or that young woman that they're going to have that $100 a month for years.
Especially with the cost of living here.
Yes. I went to Foodland yesterday and bought fruit and bread. Cost me $75. Sorry, eliminate the reference to Foodland. But it's like, what? Yeah. I remember
You went to the grocery store yesterday and what?
I went to the grocery store yesterday to buy some fruit and some bread. I thought the bill would be $20. It was $75.
Oh my goodness.
Right. So the cost of living is high. As a practitioner, I live in this world. I don't recommend clients pay anything more than what they absolutely have to. When someone says, as a young person, my friend is telling me to do this, my first question is, how long has your friend been doing this? Oh, long time. From the summer. I said, really? Has he ever actually tried it? Yeah.
I'm sorry, I didn't catch that.
Oh, yeah. Weeks. I go, really? Weeks? Yeah. And how many people has he done this for? Oh, no. I'm the first. Okay.
Your sense of humor. Sometimes I'm like...
I look at that and go, okay, bro, there's 2 words for this. What is the 2 words? Guinea and pig. Which one you want? I do this as a practitioner. I live this life. I would never do that to a young person because I cannot look them in the eye and tell them this plan is going to work. I would rather sit with somebody who's young and go, I know you get $100. You get $25? Oh, I got that. Buy the life insurance.
Start where you can.
Do what you can.
Yeah.
I've seen guys buy really expensive trucks and get it all laid up because they cannot they don't have enough money to replace the tires.
Yeah.
It's like really $80,000 truck and you cannot afford $4,000 for the tires. Yeah, the thing is expensive. Then why did we buy an $80,000 truck? To me, that's just it's poor it's a poor thing to do to someone.
Well, it's about budgeting.
Yeah.
Knowing what your limitations are and living within our means. Right?
Correct.
Yeah, yeah.
Correct.
Living within our means. So
Right.
it all comes down to that.
Yes.
Do we have more slides? Oh, looks like we're
Wrapping
nearing
up.
the end of our show. Was there anything that you want to leave our viewers with at home, though, as we discuss the accelerated benefit riders?
I think if they are wise consumers
Mm-hmm.
and they have a clear idea, not of what their friend wants them to do or what's out there in the market, what they need to do,
Mm-hmm.
what they want to do, and they're serious about that,
Mm-hmm.
right? Then they can make informed decisions about what is reasonable for them to do.
Okay. Well, thank you so much
You're
for,
welcome.
again, another informative presentation. Herb is always full of knowledge. And before we leave, I'd like to thank Olelo Community Media for everything that they've been doing in the background. They've been
Yes.
wonderful. We've been coming for months now.
Months now.
Yeah. And have really appreciated all the work that they do in the background. I also want to thank you for joining us today. And with that, I'm going to say aloha and ahui ho.